Hey, what's going on, YouTube? Kenny here. So today we're going to go over some user questions. And like always, I have no idea what I'm doing, and we're going to go ahead and do this live. One take, like always. So we'll see how this goes. I basically picked the 4 most kind of user-friendly questions, ones that I think other people probably want to know too. And so the first question is from Blessings to You, definitely an OG here. We talked about selling Jamia and taking some profits. But anyways, the question is, noobs and red fear. Is there a need or reason to ever accept red? It says, per CNN, in 2020, the average household, not average household, I read that wrong. The average hold time per share was 4 seconds. What does that say about new investors? And methinks it speaks volumes. Do we accept red or avoid it at all costs? Thoughts? Okay, so I'd have to say that I think that the question is not the question I would ask. So the first thing that you need to think about is when you talk about the average house or the average hold time being 4 seconds, the problem with that is it's very much of a misnomer. So what you're going against is a lot of quant trading and algo trading. So there was a comment the other day saying like, hey, is some so-and-so pumping this stock, or do you think he's pumping that stock? And somebody in the comments replied, no, there's not enough like volume, and not enough people doing it or something like that. The interesting thing is you don't actually need as much as you think. So there's algorithms, algo traders, quants that have momentum traders set up to scalp fractional shares. And so even if you just trigger the quants, if you can just even trigger those algos, you'll see a significant increase in volume, whether or not the folks are actually pumping it or not. So I'm not saying one way or the other if people are pumping it, but I'm just suggesting that, there's a lot of algo traders that do fractions and fractions and fractions of a second to extract, their money from the market. So don't take that question at face value, or don't take that statement at face value. And I'm sure that they probably covered that in CNN as well, but that's just one piece. In terms of accepting red, if you know the red is coming, I don't see why you would accept it. So no, you shouldn't accept red. I think you should conserve money at all cost. The longer that I've been in the game, the harder it is to really explain this, but let me try to explain. So as you first start, let me tell you how this starts, right? It's weird because on a time scale, right? Like if you're taking scalps and they're like 1 hour scalps or something like that, this is actually the hardest trade to make, is these day trades, right? These pattern day trader, day trades. The second thing that's hard to do is intraday trades, figuring out what it's going to happen tomorrow on open or whatever like that. And the easiest trades are swing trades. And then those are like a week to a month or 3 months or whatever, sometimes even like 3 months, 6 months, whatever. And then I think anything a year plus is investing. Okay. That said, based on these 3 categories, where you need to accept red, or you need to accept your stop losses and really manage your risk, is right here, right? You need to set up a system in which you are ready to take the red. Like you will have to hold through that. Intraday, same thing. Swing trade is where it kind of switches, okay? So for me, swing trade is where you should accept almost no loss at all. And so this is actually a little bit of an advanced concept, so I'm not going to go over it for you. But in terms of my portfolio construction, when it comes to these swing trades, I would say that these swing trades are, for me, 95 to 100% accuracy. And the reason why is I refuse to take a loss, and I'll just let it ride the time horizon. And these swing trades that I take that are like 3, 6, leap, those are all like your AMDs, ones that I have high conviction on, and I know it's going to hit my price target. And so I rarely ever take a loss on those. And we can kind of go into that some other time, but just kind of food for thought, just kind of understand that. And then when it comes to investing, unless it's a situation like that is totally unbelievable, like Enron, or not Enron, that's a bad example. So, no, there's just no, if you're investing, you've looked at the company long enough and you've stared at it long enough, in general, you should be taking profits on the way up anyway. So you shouldn't be in a situation where you need to be losing money on a 1 year plus investment. So I would say, to answer your question simply, but it's a little bit more complicated than that, don't take any losses here. Don't take any losses here. Here you're set up to take losses. In fact, as long as you have like a 50% win rate, you're probably going to make money just based on your risk to reward profile, right? If you're trading. So just kind of think of it like that. All right. Hopefully that answered your question. I think I'll just do a video on that because it's a little bit more complicated than I'm making it seem. Okay, so next. So any beginner tips for risk management? How do you manage your trades? Okay, so if we go to, that's another thing. You also said, you're also talking about how scary the market is. One other thing. So guys, girls, the VIX, remember we were watching the VIX for so long and we said, hey, if, it's been sitting on this 21 for a very, very long time, just scooting sideways. We even said that if it stays on that, you'll be relatively healthy for 2021. And again, this is March, right? The VIX gets all the way up to 87. But as it pulls back down, it just keeps bouncing off 21, bouncing off 21, bouncing off 21, and just sliding sideways. Last week was the first time we actually crossed back into 20 territory. So this is a very, very bullish sign. So, we were worried for a while that we were going to get a pullback, but I mean, there was a lot of deleveraging right here, degrossing, if you will. So with that and with the money that's still on the sidelines, I think we are rather bullish right now. So just some thoughts here. The indicators are lining up. Yeah, I don't think you can fade this, right? So I think it's time to probably get risk on here. That said, be careful which ones you are playing with or working towards. I definitely think you have to be very tactical and precise about the way that which you're deploying your money. But this is the time to probably deploy your money. I would watch this. Obviously, if we come back over 21, then our thesis changes again. So just be agile. Be like Gumby. All right. Next question. Risk versus reward. So how do you manage your strategy for trades? Again, I actually kind of just covered that a little bit here, but I'll kind of break it down to you. So if you're swing trading, let's talk about this swing trade real quick. And I will probably make a video, but the thing about these swing trades is like these swing trades that are taking this long, think the time, I generally would recommend for those kind of trades, right? Whatever your monthly add is, so if you're adding $200 a month, right, for instance, that should be your position size. And I'm going to tell you why. Because if you get into AMD, like you've seen AMD go in and out, in and out, in and out, right? Say you get at AMD at $92 a share, right? Which we saw, we had plenty of time to get AMD at $92 a share. Currently it's trading at like 93 or whatever, right? But say it went down again, right? Next week you went down, or next month it went down to 88, right? And we did see it drop to 88. Well, this money is now stuck, right? It's definitely not 200 anymore. It's probably 198 or whatever, right? As we see that happen, right, you're going to want to rebuy again. So let's say it's another paycheck, another month comes up, right? You want to have another 200. So this is another, what I would call a tranche, right? So for these kind of like medium-term swings, this is how I play those, okay? So now we have two, and we bought it here. But now our cost basis is between our cost basis is $90, right? Because we bought a tranche at 92 and we bought a tranche at 88, so we have a $90 cost basis, right? All right. Now, let's think about this. So we have stuck money here, all right? So right now we know it's trading at 93, but that's not our price target. So even if you bought, again, say our price target's 99, right? So even if you've bought again right now at 93, you'd have, again, cost of basis of relatively like $91, right? Because you have three positions, one at 92, one at 88, and one at 93, we're saying, right here. And so we still haven't hit our price target of 99 or 100 or whatever it is, right? We'll just say 99 because that's what we've been calling for. So now we're going to take this to kind of fruition. So we have stuck money here, right? Everything here is actually stuck because, well, we're not actually stuck. We're actually profitable because we're at 93, right? Right now we're at 93. And our cost basis is 91, right? So technically we're up, but we haven't hit our target price. So you can see how we're already profitable just using this strategy of buying and coming down, buying, and then 93 we're over the cost basis. But even with that, you say, okay, if say it slides around again, and there's another month and another $200 comes out from your paycheck, right? So you ask yourself, I'm at 93 now. Do I still buy because 99 is my kind of level? Yeah, absolutely. This is the absolute reason you should be buying, right? Because you're essentially saying you have a high conviction of this happening. So there's 0% chance in your mind, or very, very, very low chance that you'll not see 99. So with that said, you buy another one or you don't. Okay, let's just go with the thought experiment that you don't buy another one, all right? But here's the whole point about tranches. So this goes into the second question too. So as we go up, right, and we hit 99, and remember we had this channel. So we have three tranches now. And I always get this question like, which one do I sell? So all things considered, if you're not playing options and you're not doing leaps or something like that, you would, for me, if it's options or leaps, it's pretty simple. You sell the one that's most profitable, or you sell the one that's about to expire, closest to expiry, right? Okay. Other than that, if you're doing it this way, this scenario right here, all you got to do is sell a tranche up here at 99, right? And for AMD, we said 118 is our next price target. So you have two price targets, okay? The very first one where you're willing to sell tranches, and the reason you sell this tranche, right, is because here's the problem. Most of you all don't have any money left, okay? So what you do when you sell this tranche, now you have two tranches and you have cash, right? And that cash can be redeployed. So if we come back down here and hit this target and we hit that support line, we can, again, buy more money or buy another position. So when we buy that position, we can go back and forth, rinse and repeat. So the point here is to always think about how you're going to manage that. All right. And if you want to just exit your position, then yeah, you can sell up here and exit your position. Of course, you're profitable. But if you have a second price target for AMD, we have two price targets, right? We have the channel price target, right? And then we have the actual true price target for the end of the year. So that's why you sell tranches when you hit resistance, right? When you hit any type of resistance, you want to sell a tranche, okay? Whether you think you're going to go up or not, you just sell it, okay? And you say, oh, Kenny, then if I know it's going to go to 118, why would I sell it at 99? That's because you don't know, right? Here's another point to that, okay? So as soon as you go to 99 and say it bounces around up here, now this is the new support, right? Now that we know that this is the new support, then you could definitely buy it when you hit support again. You buy it back, right? You buy it back. You didn't make or lose any money, but now you know because you have relatively good support, because you confirm support, now that we can go back to 118. Does that make sense? I think it does. I might go ahead and do this on PowerPoint to kind of really explain it, but I kind of want to answer it all in one video right now because people are asking. I think I can definitely put this in PowerPoint and actually go through it kind of nice and slow, but hopefully that kind of answered your questions. That's going to go into the next question too, actually, because I think Paige asks the same question. Building off this process, setting price targets, how often do you go into selling tranches versus selling your leaps and setting it up and forgetting it and not volatile. Okay, exactly. So that kind of answered your question. The only thing I didn't answer is setting it and forgetting it. So the setting it and forgetting part is essentially when I set it and forget it, it's stocks like Jumia, it's stocks like when I bought Activision back in the day, it's things like Bitcoin. These are 5 to 10 year horizons. It's things like when Roblox comes out, I'm buying Roblox and I am going to let it run. 5 years is the minimum for these. They'll set it and forget once, and then 10 years is what I really am looking at. Obviously, you want to look at it like, every 6 months or something just to make sure the fundamentals didn't change. Like if you get humongous drawdowns, you might want to re-examine. But do remember that Amazon did take a 90% haircut before it ran up like 1,000,000%. So don't get too worried about it. If you have high conviction, you did your due diligence, just go with your due diligence and just kind of hold. You always want to re-examine, but if your thesis hasn't changed, let it go. The stock will, or the company will do its work for you, especially if you find the right company. And that's why we do so much due diligence. Okay, so you know what? We have another question here from Connor about price targets. I'm gonna have to go ahead and end this a little bit short here. Sorry, Connor. We'll get to your question though for sure. I think that's a good question. How do you get price targets? And we'll definitely take a look at SPWR. But we're already at 16 minutes, so we're gonna go ahead and call it. All right, yeah. Hey, thanks for watching, and if you like this thing, just go ahead and help me tell YouTube that you thought it was pretty cool. And that's really all I'm asking for. Also, if you want to join the Innovation Lab, or you want more details about that, email me at kenny@redcliffresearch.com. It's a place that we do cool things and try to figure out how to solve the market, even though we know it's probably not solvable, but we give it our dangdest. We haven't started yet. We're going to start in about a month. It's pretty cool and interesting. We have a lot of interesting people already that have signed up. So if you want to hang out and talk and stuff, this is not the Slack chat. The Innovation Lab is different from Slack chat. Slack chat is just still not open. We will open up Slack chat again relatively soon. I might just put a link down today. Okay, thanks for watching, and we will talk to you tomorrow.